only time you would use a C corporation, really what C corporations are for raising capital. So an S corporation is meant to be a small business. By law, S corps cannot have more than 100 members or 100 owners. They cannot raise foreign capital or have foreign ownership. They're meant to be kind of straightforward American small businesses. If you want to attract foreign investors, if you want to issue stock and have more than 100 owners of the company, that's why you use a C corporation. And those benefits that it offers in doing that also exposes you to double taxation. Hey, tax patients, Eric Wright here. Today we're going to cover business structures, C Corps, S Corps, LLCs, PLLCs, PAs. What's the difference? Which one should you choose if you're self-employed? So let's jump right in. Let's go back to the days of yore, back to the 1950s, and look at what business entities were available, because that kind of sets us up to understand why there's all these different entities nowadays. Back in the 50s, right after World War II in the US, you could either be a sole proprietor or you could be a C corporation, a corporation with a big old capital C. And the reason why people chose to be corporations versus sole proprietors is because of the liability protection. So especially if you have business partners, if you're a sole proprietor, you could be held liable for the actions of your business. You could be held liable for the actions of your business partners. And having a C corporation in place essentially insulated the owners or shareholders or members of a business from the business liability extending to their personal assets. The problem with the C corporation was it was subject to double taxation. So basically the company would have revenue, and then it would subtract its expenses, and then you would have a net profit, and the company would pay a corporate income tax on that net profit. And then the money that was left over after paying corporate taxes would go to the owners or the members, the shareholders, and then they would pay income taxes on that. So you had to pay a corporate tax and then an income tax. As a sole proprietor, you don't have that. The sole proprietor doesn't pay any corporate income tax. They just pay personal income tax on their share of the net business revenue. And this was problematic because this really disfavored small businesses that were just starting up or small partnerships. And so the government recognized this and they said, all right, we have to fix this situation. So they introduced what's called S Corp taxation or S Corp tax designation. An S corporation is not an entity. Basically, you could set up a C corporation, but then you could file to be taxed as an S corporation, which is essentially kind of like a sole proprietor. You would have a C corporation underneath, but as an S Corp tax designation, you don't have to pay corporate income taxes. You're treated like a sole proprietor. The money just flows through to your personal income, and you pay personal income taxes with no corporate tax, no double taxation. So you get the benefits of liability protection of a big old C corporation without the double taxation. So moving along to the 1970s, I think it was Montana that established the first, Wyoming or Montana, the first LLC. In 1977 or 1978, the first LLC was introduced, and this was a state-level corporation. And at first, the IRS didn't really know what to do with these state-level corporations, but they decided to disregard them. So an LLC, if you have a single-member LLC, you file taxes as a sole proprietor. I know LLC has the word company or corporation, if you want to call it that, in it, but you're still a sole proprietor. But you still get the liability protection of a corporation just with the pass-through taxation of a sole proprietor. LLCs kind of replaced the C corporation with S Corp tax designation. So today, if you want to be an S corporation, people will set up an LLC. They won't bother with setting up a C corporation. So basically, they had the LLC, and different states had different types of LLCs. You'll hear about PLLCs, you'll hear about PCs, PAs, LLPs. These state-level structures are basically just state-dependent. They're all the same thing. They're an LLC, which is limited liability, with pass-through taxation, with no corporate double taxation. And the reason you choose one of these different types is entirely dependent upon what your state wants you to use. So if you're most states you can have an LLC. If you're a doctor practicing medicine as an LLC in Texas, you have to have a PLLC. That's what Texas wants. If you're a doctor practicing medicine in California, you have to have a PC because that's what California wants. So it's really just kind of up to your state. Some states you can have multiple members owning an LLC. Other states, like New Jersey, you have to have an LLP, a limited liability partnership. And so it just really is totally dependent upon what your state wants. And otherwise, all these things are basically the same. They're just LLCs without double taxation. So the one trick is you can still have S Corp tax designation. Now, why would you do that? So let's say you set up an LLC. Well, it's because there was a tax benefit of the S Corp tax designation when Congress passed it in the 50s, and people still wanted to retain that. So Congress and the IRS have retained this S Corp tax designation. And the reason you use it is basically you can treat yourself, or the shareholders of a company can treat themselves as employees of the company, and they can draw a salary from the company, and then any money above the salary that they're entitled to can be treated as a distribution. And a distribution from the business is not subject to the payroll tax, which is Medicare and Social Security. So the amount of money that's between the money that you're owed by virtue of your ownership of the S Corp and minus the salary that you're drawing from the company is your business distribution. You don't pay payroll tax on that. So there's a tax benefit having an S corporation. This typically starts applying, if you have $50,000 to $100,000 plus of 1099 revenue, then that's when you start thinking about, electing an S Corp tax designation, that it starts to become worthwhile. But that's basically it between C Corps, S Corps, LLCs, and all the other acronyms out there. For most physicians that are 1099, just having a simple LLC, or of course, if you're in a state that wants you to have a professional LLC or a professional corp, a PC, you have that. And then if you make enough money, you elect S Corp tax designation for the tax savings. That's pretty much it. The only time you would use a C corporation, really what C corporations are for raising capital. So an S corporation is meant to be a small business. By law, S corps cannot have more than 100 members or 100 owners. They cannot raise foreign capital or have foreign ownership. They're meant to be kind of straightforward American small businesses. If you want to attract foreign investors, if you want to issue stock and have more than 100 owners of the company, that's why you use a C corporation. And those benefits that it offers in doing that also exposes you to double taxation. So, companies like Amazon pay corporate taxes. The small business down the street from you is probably not a C corporation, so they don't pay corporate taxes. And that's really kind of the difference. So, that's it for this episode. All right, thanks for listening, and we'll see you next time.
You've been listening to the 1099 Tax Doctor podcast. Dr. Eric Wright isn't just talking about 1099 income, he lives it. As a physician and independent contractor, he's learned how to make the tax system work for him and for his colleagues. Learn more about how Dr. Eric Wright helps physicians keep more of their hard-earned income by visiting 1099taxdoctor.com. This podcast is educational only and not personalized tax, legal, or financial advice. We're here to talk strategy, not write prescriptions. Always consult your own licensed professional before making decisions about your own financial situation.